Ares Management is out with its latest results today. Shares rising as the company reported assets under management grew 19% year over year to nearly $419 billion, topping estimates of $409 billion. Ares CEO Mike Arougheti joins me now as the stock price hits a new record after a tear last year, I should say. Mike, when people look at what you're doing over at Ares, it's pretty notable because you went from 0 to 60. It seems like you've become much bigger than some of your older rivals like Carlyle, for example, and market cap. What is it exactly that they're betting on? Is this kind of rising with the private credit boom, or is there something else?
I think a lot of the relative momentum is clearly credit. We were very early to the private credit markets, dating back almost 30 years. And as that market has expanded, both in terms of moving into real estate and infrastructure, but also globalizing, it's been a big tailwind. But whether we're talking about private markets or public markets, at the end of the day, it's about performance. And I do think if you look at the earnings performance over a number of years, it stands out for its consistency, but also for its growth on a relative basis. So, I think at the end of the day, assets follow performance and stock price follows the performance as well. So we're just going to keep doing what we're doing.
I feel the need to really push you on performance here and how sustainable it is across the industry, not just for Ares, because there are a lot of worries out there, Mike, about credit quality, when it starts to turn. How do you avoid pitfalls, and how many pitfalls are there in the market right now in the world of private credit?
I think that story, frankly, is a little overblown, and you and I have talked about this before. The structure of the market is fundamentally different than it was 30 years ago. But if you go back to the beginnings of this business, the narrative was always there that there was risk being taken in these markets. It wasn't being taken anywhere, and I just don't think that that's true. And the performance would bear that out. If you look at ARCC, which is our traded BDC, we announced earnings yesterday. And the non-accrual rate in that portfolio is 0.6% at fair value, which is well below the industry historical average of about 3%. So it's quite interesting. Obviously, the stresses you're seeing in certain corners of the market, like real estate, are rate-driven. But when you get below the surface, the fundamental performance is still very strong and very intact. But what's different about private credit today than decades ago is the amount of private equity supporting these assets and companies is significantly higher than it ever was. So if you look at most private credit assets, their loan to value is somewhere between 40 and 50%. That means that you have a highly sophisticated, highly aligned equity partner sitting below your private credit instrument that is obviously aligned to performance. So I don't expect to see private credit, as we all talk about it, show cracks, because I think the structure of the loans is just fundamentally more sound than it's ever been.
You think about the market's expectation for rate cuts here. I'm curious about your weighing in on what would happen if we don't get 5 rate cuts before the June FOMC meeting and rates stay a little higher for longer. What other kinds of cracks do you start to see in credit markets at that rate?
Yeah, I think real estate, you're beginning to see those cracks emerge, right? So as rates stay higher for longer, which, by the way, is my base case, you're going to begin to see even, modestly underperforming assets have challenges. And this goes back to my prior comment about the value of institutional sponsorship, right? So if you have an institutional sponsor of a high-quality asset, they will use their capital to protect the value in that asset or that company. And if you have a weaker asset or a weaker company without sponsorship, there may be some challenges. So obviously, the longer we go with rates higher, you will see more cracks. But I think if you aggregate across all of the markets, we're at peak rate. We know we're going to be coming down from here. And I think that's going to be constructive both for performance and deal activity.
You think about what's happening over at New York Community Bank. It's causing a ton of fears in the regional banking system. You yourself have really pointed to the idea that this could be a multi-year problem. Paint a picture of how that plays out through 2024 and even 2025.
Well, it speaks a lot to prior comments that we've made just about the importance of private markets in stabilizing the public markets. And so you look at 2023, and obviously there was a lot going on, but we got through, pretty challenging time in the bank markets through a combination of private capital, public capital, and policy. And I think given what we saw play out in first and second quarter of last year, I would continue to believe that these isolated instances like New York Community Bank are going to be resolved with a combination of private markets partnership and bank capital. So I'm actually optimistic. I think that the markets are proving to be resilient. There's enough liquidity to resolve these. But it is a commentary, I think, on the fundamental difference in the structure of a bank balance sheet and the structure of an unlevered private fund. And when you go through this amount of rate hikes so rapidly, it exposes those weaknesses. So I actually think that this is going to help, advance the narrative of the importance of the private markets and partnering with banks and partnering with the liquid markets as we get through cycles.
So, okay, New York Community Bank reported just yesterday will go to market. It's exploring loan sales and other ways to offload risk. Would you be in talks with them in a situation like this? Are you in talks?
Well, I can't comment on that specifically, but I think, as you know, earlier last year, we executed on a major portfolio purchase from PacWest. Towards the back half of the year, we announced that we had partnered with another regional bank on a pretty meaningful risk transfer. So, yeah, I think that given our capabilities in private credit, in alternative credit, and just given the amount of liquidity we have, I think that we are a natural partner for any bank that's looking to reposition its asset mix.
It's interesting. You had, for example, Harvey Schwartz, the CEO of Carlyle, yesterday tell me that he wouldn't be willing necessarily to head into some of the commercial mortgages that are being offloaded by these banks. We know that commercial mortgage risk is what's weighing on the sector most heavily. Is there a place that you could step in?
Well, I think, again, everyone likes to paint real estate with one brush, and, real estate means a lot of different things. And if you look at our exposures, what we see given our over-indexing to industrial, multifamily, student housing, data centers, there are very big parts of the commercial real estate business that are performing very well, even in this rate environment. So I think most of the stress that we're talking about is obviously going to be happening within the CBD office market. That's a tough place to be. But as an example, we just launched a joint venture with a very prominent New York real estate partner to begin to look for opportunities to bring capital into that market for Class A properties. So a lot of this, whether you're talking about commercial real estate or buyouts, is really about what's the value of the enterprise or the asset. When are you comfortable resetting basis and bringing money in? And I think we will find a natural bottom and a natural clearing point for real estate as well.
What's that clearing point? I think I've been asking that question for a year now. When do things, frankly, get bad enough for you to buy?
Well, we are buying. We're quite active globally in our real estate business. The bulk of what we've been doing, and this is true, across the platform, is using debt-like instruments or debt structured equity to come into these balance sheets effectively above the equity, try to be a good, collaborative liquidity partner, but not necessarily have to underwrite equity risk. So part of the benefit of our scale and flexibility is that we don't actually have to come in, and have a perfect view on the value of the equity in order to come in and be a partner. I think that's one of the benefits of flexible capital and opportunistic credit.
It was an amazing fundraising for you last year. It was the second best fundraising year you had on record, I believe. And you're in the market, according to Bloomberg's reporting, for a record direct lending fund. How much appetite is there for private credit to continue at that pace? And where are you putting all this money to work?
Well, how much time do you have? We just had our earnings call earlier, and someone asked a similar question. And, without getting too deep into it, the reality is that the private credit markets, even though they're having a moment, are still massively undercapitalized relative to the amount of institutional equity that needs some form of private credit solution. So, just as an example, there's about $1 trillion of uninvested private equity dry powder in the market against roughly $200 billion of private credit dry powder. So for all of the attention that private credit is getting, there's just not enough private credit in the market to satisfy the private equity that's already been raised, putting aside some of these cyclical opportunities that we're talking about. So I think that there's plenty of appetite. The return opportunity in private credit across the different parts of the market is as good as we've seen in a very long time, since the GFC. And I think people are seeing the seniority and the structural protections, and will continue to allocate. So
it's interesting. Yeah. A year ago, Mike, or even just a couple months ago, you and I were sitting here looking at a bank market that struggled to compete with firms like yours. They were struggling to offload leverage loans that were saddled on their books. Now they look like they're starting to fight back and edge their way into deals. How do you describe the bank versus non-bank dynamic here?
Yeah, we've been doing this for 30 years, and you could go back and I've been saying the same thing through every cycle. There are moments where the banks are less aggressive in risk-taking, or the liquid markets are less aggressive in risk-taking, and the private credit markets have the opportunity to take share at the upper end of their size range. And then there are times when the syndicated markets are, risk on, and then you give up a little bit of that share at the high end, but transaction activity picks up and everybody wins. So given the way that we've positioned our business in the core middle market for so long, I've always viewed this opportunity to kind of trade share with the banks at the upper end of the market as, episodic, but that's not the core business. Not surprisingly, Ares has a very large liquid credit business as well. We're a very large CLO manager. And so when those markets turn back on, we have the opportunity to pivot into that market as well, to obviously fund the growth in our liquid business and also to drive underwriting. So it's not a new trend. It's been like that for the last 20 years. And, I think I wouldn't even say they're fighting back, but they are now in a position to take risk, and they're going to do it. And
that's in leverage loans, Mike. What's interesting is you see many of these banks, JP Morgan included, looking at private credit, entering it in a bigger way, either through partnerships, hiring, raising funds of their own. How does that change your market?
I don't know if it does. And again, I struggle with what is private credit, right? Private credit is making loans. So JP Morgan is one of the largest lenders on the planet. So when I hear that they want to get into private credit, I'm not quite sure I understand what that means, because I look at them as the largest lender in the market. And if you start trading loans, then it's no longer private. So I think everyone is struggling to kind of get a shared understanding of what this is and what the opportunity is. But again, we've been coexisting largely as partners and collaborative partners with the banks for as long as we've been in business. And whether they're taking exposure through syndications and on the sales and trading desk, or they're doing it directly on their balance sheet, I don't really perceive that to be, a meaningful change in the way the markets are structured.
Mike, you're certainly rising at Ares and rising as a CEO yourself. You're very notably on the deal to buy the Baltimore Orioles. We should say Michael Bloomberg, who is the owner of Bloomberg LP, is also part of that Orioles ownership group, along with David Rubenstein, also a contributor to this network as well. What is this deal about for you?
Are you offering me a job at Bloomberg? Is that what that was?
I am certainly not, but I am wondering what you were doing buying the Orioles. Certainly sports has been a big moment for high net worth individuals as well as private asset owners. What does this say?
Well, I think first of all, it says that I'm just a lifelong passionate baseball fan and just thrilled to have the opportunity to be involved in something like that, especially with a franchise that is so long tenured and has such a deep history as the Orioles do. And I also, I've known David for, 25, 30 years, and I think he's one of the great leaders in the community and in our business. And so the opportunity to partner with him behind his leadership is kind of a once-in-a-lifetime opportunity for me as well. And you're right, sports, it's funny. We have a big sports business here at Ares, I think, as you know, and in a world that is increasingly divisive and political and tribal, what you begin to realize is sports is the way that we all come together and rally around shared ideas and values. And so I'm passionate about baseball, and I'm passionate about what sport, means for society, and thrilled to be now a part of the Baltimore family and looking forward to the future.
Mike Arougheti, we thank you so very much for your time. Certainly another big year in your world.